Let's look at the required. Part A, calculate the taxable income for Hyperion for the 2019 year of assessment. Commence your calculation with the taxable income of 15,300,500. Show all your calculations clearly and indicate clearly with explanation where an amount has no effect. Hyperion has indicated that it wishes to reduce or defer its taxable income as far as legally possible. That means they'll apply section 13.3, section 11.0, paragraphs 65, 66, and if you apply paragraph 65 and 66, section 8.4e. Those are all ones that you need to choose yourself to apply. All right, so part A. Again, guys, each question, start off a new page, clearly indicate your headings so we can score those sweet presentation and disclosure marks. Calculation / explanation. I like to do a capital gains tax column and rands. There we go. Right, so we have to start with our taxable income that was given to us. All right. So let's go all the way to the top, start of it. So first one is issue 1. Okay, so what happens in issue 1? In issue 1, this is the situation where they decide to remove a computer from trading stock. This computer was manufactured in the previous year. They tell you that the accountant has treated it correctly for opening stock. So what I would suggest we do, just to show you, is to say opening stock, no adjustment. Some solutions have marks for it, some do not. That's why I've included it over here. So no adjustment. Then it's now the transfer. So the first thing is transfer to PPE. Now this is where there would usually now be a disposal that you'd have to discuss and so forth. Here we will say paragraph JA of the gross income definition applies, and the computer will continue to be treated as trading stock. Okay, now guys, your solution is obviously one that I've compiled myself, so please also do work through it, the layout there and everything, how it looks. I want you to do the same. Okay, so if I take a little bit of a shortcut, the solution, the printed solution is how you want it. Okay, then at the end of the year we had this amount still, we hadn't sold this asset. So if you sell this asset now later, you won't treat it as a capital asset that you're selling, you'll treat it as trading stock. So at the end of the year, we've got closing stock, section 22(1). And you need to always put down a rule, lower of cost or market value. Cost is 37,000, market value is 35,000. Closing stock is the amount that we add back. Right, there we go. Reasonably simple, I think. Issue 2. Right, so these are where the computers were donated to Incredible Connection. 20 computers were donated. So the first thing is they tell you it was manufactured in April, because they tell you the accountant has not done anything with this. Right, so let's start with the manufacturing. Okay, how much did that cost? 25,000 rands a computer. Sorry, and how many computers? 20. So 20 times 25,000 gives us a nice 500,000 deduction. Then we transferred to donated to Incredible Connection. It's not a pure donation, as you can see here, because we're agreeing to marketing. We can call it a donation here, but it's actually, you can see, as we do marketing. Right, we're now with 30,000 rands. Right, so this is section 20.8 that tells us to do that. And then, because this is a marketing expense, we can claim that same amount back as a deduction. Okay, then we have this block rent story, where we lease a property. Okay, so let's take it step by step. So the first one I would do is the monthly rentals. Now remember again, guys, we entered into this at the end of previous year in August 2018. So we had it an entire year and we used it. So rentals, section 11A, 250, was it 250,000? Yes, 250,000 times 12. Then we have our lease premium. The lease premium is 1.5 million rands. So 1.5 million divided by 19, because that's the duration of the lease, and we had it this entire period. Then we have our leasehold improvement. Okay, so let's start it as follows. I'm just going to do it in a different color here. Total period of the lease. Years, months. 19 years times 12, 228 months. Remember, you can do any one of those. Time to complete. Now, remember, we started building this, we entered into this on the 1st of August, and it took until the 1st of May, so end of April. So 1st of August 2018 until the end of April 2019, and that is 9 months, and 9 divided by 12 means it is 0.75 of a year. So that gives us time or period remaining. Okay, so now when we do section 11G, you can either say, remember the contract told us that we had to do it for 4 million rands, we spent 4.5 million rands, we used the lower of the two. So 4 million divided by 18.25. I'm just going to remind you, we use this from May. So May to December, it's 8 months. So times 8 over 12. And that gives you 146,119. You can also say 4 million rands divided by 219 times 8, and it gives you the same amount. So whichever one you prefer, as long as you know what you're doing in an exam. Right, so that was on the 4 million rands, but it actually costs, so we spent 4.5 million rands, but we only used 4 million rands in section 11G now. So now we get for the excess improvements under section 13, so that'll be 4.5 million minus the 4 million. Still doing a little pre-calculation in my head there, gives us 500,000 times 5%. Alright, that's it. Then we have issue 4. So now a lot of things happen in issue 4, obviously. So the first thing is, there are two things that's destroyed. Machine A is destroyed and the factory is destroyed. We received 980,000 including VAT for machine A, but it's not replaced. So let's start with machine A, get it out of the way. So the indemnity award that you've received for this machine, excluding VAT, is 980,000 times 100 over 115. Gives us 852,174. Indemnity award for machine A, sorry. Indemnity award for machine A. Indemnity award for the factory, excluding VAT. We received how much for the factory? 2.9 million rands. Okay, so I just like to do that so that I have these amounts available, the excluding VAT amounts. Okay, so here we go now. I'm just going to change the color here just to make it a little bit clearer. Destruction of machine A. So this is a disposal for capital gains tax purposes, because we go from having a machine to not having a machine. Right, so let's quickly look. Cost was purchased new in 2017 for 820,000 rands, wasn't replaced. Right, so cost 820,000. Lease section 12C. In 2017, we claimed 40%. In 2018, the previous tax year, claimed 20%. This is 2019, the current tax year. Please remember to claim that amount from your taxable income, otherwise you will not get your mark. This gives us a tax value, 164. So usually we now say selling price limited to original cost, which you'll remember means lower of the actual selling price or original cost. Now we just say indemnity award, just to show you examiners we know what you're talking about. Sorry, I don't know what I'm writing there, but this is limited to original cost. So original cost is 820,000. Indemnity award 852,000. So we use the lower of the two. That gives us a recoupment of 656,000. This asset is not being replaced, so that full amount goes into my rands column. Very important that you see that. Capital gain then. Proceeds is that 852,174 minus my recoupment amount. Right, not the amount necessarily that I've included over here, but the amount that we've calculated over there. Base cost is the cost of the asset, 820,000. Less our allowances. The sum of the allowances over there. Right, gives us a base cost of 164,000, which is obviously equal to our tax value. Usually it is the case. But you can't just take that shortcut, please remember. So that gives us a capital gain, 32,174. That amount, important, goes into my CDT column, not deferred. Let's compare that now to the next part. Now it is the destruction of the factory. Okay, so the factory was purchased in 2013, but we only started using it from 2014 for 2.2 million rands. So cost 2.2 million rands. Next section 13. So this is from 2014 until 2018, the previous tax year. You can obviously write it out and do each one separately if you want, but it's a bit long. So it's 2014, 15, 16, 17, 18. So 5 years. Make sure you see that. Students will often now say it's just 4 years. 2018 minus 2014 is 4 years. That's not right. 2014, 2015, 2016, 2017, 2018 is 5 years. So then, I'm just showing the current year one separately. Why? Because that 110,000, you must go and show in your rands column. That's the only reason why I'm doing it separately there. Please don't forget that, guys. Don't throw away that mark. It happens very often with students throwing away that mark. Right, gives us a tax value 1,540. So indemnity award limited to original cost. My original cost is 2.2 million rands, and the indemnity award is 2.5 million rands. So you can see the original cost is the lower of the two. Okay, so this calculates a recoupment for us. $660,000. Now usually I go and put it into my taxable income column, but not this time. Why? Paragraph 65 will apply. So thus the recoupment is deferred under section 84E. Okay, because remember that section 84E applies if paragraph 65 or paragraph 66 applies. So we do not include it over there. That's what we're doing. So I want you to see nothing for now. See below. Okay, we're going to work on it below. First, let's also just do the capital gain, get that out of the way. So the capital gain is the proceeds. The proceeds is 2,521,739 minus my recoupment. Now guys, 660,000 is recoupment. You don't say it's null because nothing was included. That's why it's so important that I always tell you to use this recoupment amount over here that you've calculated. Okay, so minus 660,000. Base cost is our cost. less allowances. Our allowances is the sum over here. Okay, and that gives us a base cost 1540, which again you can see works out to be the same as our tax value, which usually is the case. But remember, base costs are actually calculated. You have to consider here other costs as well. If there are other costs here, then it won't work out in that same way, obviously. So this gives us a capital gain of 321,739. Now usually I go and put this into my CGT column, but not this case. Paragraph 65 applies. Thus, the capital gain is deferred. See below. Okay, so far so good. Now we have to go and defer it. So let's first look at it. So what I want you to see, okay, so remember now what we're going to do with the deferral. You are going to use that recoupment and that capital gain, and you're going to defer it over the period that you're writing off the new assets. Now we have two new assets. We've got the Mercedes and a monitoring system. So you're going to have to work out what amounts of those are being written off, and you're going to defer it over that same period. Okay, so what we're going to now do is just understand for now this concept, this capital gain, and this recoupment we have to defer. I'm not doing that right now. So I'm doing the Mercedes and the monitoring system. I'm going to calculate their capital allowances. Once I've done that, we can do this deferral. All right, so just bear with me. So we're now looking at the Mercedes. So let's go and do its tax, everything relating to it. So what happens here? It's a Mercedes that costs 900,000 rands. You give it as a fringe benefit to your managing director, and there was some VAT incurred. Okay, so let's do the first one is, let's do section 11E, that's the wear and tear section. Right, it is 900,000, guys, that's the cost including VAT because input tax is denied. 900,000 divided by 5 years times, we had it from August until December. August, September, October, November, December. Okay, so that gives us 75,000. Then we have the fuel expense, which is a deduction under section 11.8, the general deduction formula. The fuel is 11,000 rands including VAT. Remember, the VAT is 0 rated. Okay, now we have the output tax, or VAT if you want to call it, just in this case because we are looking at income tax, on the fringe benefit. Okay, so now guys, this is obviously something that you've studied under VAT, which you would have memorized. So it is the cost including VAT, right? So we exclude the VAT first. You multiply it by 0.3% if you could not claim the input tax, which is the case here, or 0.6% if you could claim the input tax, not the case. Then you have to deduct 0 or 85 rands. 85 rands is if the employee is paying all the maintenance, which is the case here. So we deduct 85, always 85. We multiply that by our tax fraction, and we multiply that by the number of months, which is again 5 months. Then, this isn't always shown in solutions because it's implied. You have to apportion it for the taxable suppliers. Okay, so this amount, guys, is output tax that we have to pay, and that gives us 1476. So So we can claim that as a deduction. So what's going to be important here? This wear and tear over here. Okay, I'm going to use that in a little bit when we look at our deferral. But I'll do all of that in one big chunk. So the next one I want to look at, so we've done there, is now we look at the monitoring system. Sorry guys, the previous one also did say the accountant didn't do anything. Now let's look at the monitoring system. Actually, just monitoring system. Okay, so remember now, the monitoring system is the one we purchased on a suspensive sale agreement. We already did this whole big calculation, so I'm just going to remind you quickly what happened. The cash cost is 2.1 million rands including VAT. So that means, if I just get rid of this highlight just to make it a little bit more clear at first. That means the cost excluding VAT is 1826, the VAT is 273. We will claim our allowances on this monitoring system, the Section 12C allowance on the cost excluding VAT. So let me actually do that first. Section 12C. We use the cost excluding VAT. Now guys, you will obviously have to show this calculation at some point. So it'll be 2.1 million rands times 100 over 115. I'm just going to use it here. You obviously have the solution and we already did the calculation. So 1826087, this is a new asset, so times 40%. And again, this line is going to be important for us in a little bit. Okay, that's the first bit. What else can we now claim on this asset? We can claim the finance charges. Now remember, the finance charges is 540,000. It's over 48 months. So per month, it's 11,250. This is for November and December. Okay, sorry, I just want to see that amount again. 540,000 was the finance charges that we calculated. So 540,000 divided by 48 gives us per month, and we had this for 2 months. November plus December. Okay, so 22,500. Now, and I'm going to change the color here, deferred amounts recognized. First is the recoupment, and this is under section 8.4e. Right, deferred amounts recognized. Okay, so now what you need to remember is we replaced the asset. So this is the factory, and we replaced the factory with a Mercedes and a monitoring system. So now we have to apportion it. Now I'm going to remind you what we did. The Mercedes, what cost are we going to use? 900,000, because we must use the cost including VAT, because input tax denied. The monitoring system, we use the cost excluding VAT. That means the total that we spent is 2726087. That means that Mercedes makes up 33% of that, and the monitoring system makes up 67% of that. So 33% of the recoupment and capital gain we will apportion on the Mercedes' method, and 67% of the recoupment and the capital gain we will apportion on the monitoring system method. Okay, so how do we do that? So the recoupment, I'm going to say here, using Mercedes and using the monitoring system. Okay, so I'm just looking at the recoupment now. So what was my recoupment, guys? It was 660,000 rands. Remember, this is now for that factory. Okay, so first thing is, what I'm going to do here is I'm going to just show you. We say 660 for both of these. So times 33% and times 67%. So we're saying what portion are we using the Mercedes and what portion are we using for the monitoring system. Okay, remember now, that's those amounts. Okay, now I want you to see. What did we do with the Mercedes? We said divide by 5 times 5 over 12. So times 1 over 5, that's divide by 5, times 5 over 12. So we do what we did there. What did we do with the monitoring system? We multiplied it by 40%. So times 40%. So this is a recoupment, 1.8, 150. Okay, so that was on the recoupment. Now we will do it on the capital gain. Same story. Using the Mercedes and using the monitoring system. How much was our capital gain? 321,739. So 321,739 times 33%. 321,739 times 67%. Right. What did we do? I'm going to take you back. What did we do? With the Mercedes, divided by 5 times 5 over 12. Okay, so divided by 5 times 5 over 12. What did we do with the monitoring system? We multiplied it by 40%. So times 40%. So this goes into my CGT column. And that is it for that issue. Our final issue here, issue 5. This is where we entered into the agreement of Sugar Rush, where they gave us an amount in advance, R1,000,000. Remember, they tell you that the accountant has included that. Okay, so let's actually quickly just... So issue 5. So, amount received in advance, no adjustment. Why? You would include it here, but they tell you that the accountant has already done it. Okay, so there's no further issue. Then we incurred expenses under section 11A. The expenses were 200,000 rands. Then remember now, what are we going to do for section 24C? You say expected expenses. Now, we received R1,000,000. So whatever the amount is that you've included in your calculation for that year, R1,000,000. And what is the expected expenses? Remember, the gross profit is 45%. So what did we say we expect the expenses to be? 55%. Good old-fashioned MANAC. Right, so 550,000 rands less actually incurred to date. So we have already incurred 200,000 rands, leaving us with 350,000 rands. That 350,000 rands is a deduction under section 24C. Alright guys, so that is it basically. So what do we have to do now? Now we get to the end of our question. We have to add up everything in our CGT column first. So we have this 88,226. We have this 8848. And then somewhere here we have 32,174. Right, 129. 248. Okay, again guys, doesn't really matter what that total is as long as you've added everything. Any capital loss brought forward? None. That gives us our net capital gain. We then have our inclusion rate. The inclusion rate is 80%. Gives us our taxable capital gain. So 103,398 goes into my rands column, adds up everything, and that is my taxable income. Remember to watch out for the nation's tax under section, or not the nation's tax, I beg your pardon, the nation's deduction under section 18A. That must always be performed last, and the CGT calculation right before that. Alright, that is it then for part A.